For most people, the loss of wealth does not arrive as a sudden event. It does not come with dramatic headlines, market crashes, or bank failures. Instead, it unfolds quietly, year after year, hidden behind policy decisions, inflation statistics, and interest rate targets. This quiet process has a name: financial repression. Financial repression is a set of economic policies used by governments and central banks to reduce the real burden of public debt. It allows heavily indebted nations to manage obligations without explicit default, without drastic austerity, and without immediate political backlash. Instead of openly restructuring debt, the system gradually transfers wealth from savers to borrowers, often without them realizing it. To understand financial repression, we must first understand the environment that creates it. Periods of extreme debt accumulation. Throughout history, nations occasionally reach levels of debt that become difficult to repay through normal economic growth. Wars, financial crises, demographic shifts, and prolonged fiscal deficits push sovereign borrowing to extraordinary levels. When this happens, governments face a limited set of options. They can raise taxes, cut spending, restructure debt, allow inflation to erode obligations, or engineer policies that quietly shift the burden across the economy. Financial repression is the most politically subtle option. Instead of forcing painful adjustments immediately, policymakers design an environment where debt becomes easier to carry while the real value of savings gradually declines. The mechanism relies on several interconnected tools. The first tool is low interest rates. Central banks maintain interest rates below the rate of inflation for extended periods. When inflation runs at 5% and safe government bonds yield 2%, savers are effectively losing purchasing power every year. This negative real return slowly erodes the value of government debt. From the government's perspective, it is an elegant solution. The debt remains nominally intact, but inflation gradually reduces its real burden. The second tool is inflation management. Moderate inflation acts like a slow tax on stored wealth. Cash balances lose value, fixed income investments fall behind rising prices, and the real value of outstanding debt declines. Inflation does not need to be extreme to have powerful effects. Even modest inflation, sustained over a decade or more, can dramatically reduce the real burden of national debt. The third tool is regulation of financial institutions. Banks, pension funds, and insurance companies are often required directly or indirectly to hold large quantities of government bonds. Regulatory frameworks classify sovereign debt as low-risk assets. Capital requirements encourage institutions to accumulate these securities as part of their portfolios. This creates a steady, reliable demand for government debt. Even if market forces might otherwise push yields higher, institutional requirements help keep borrowing costs low. The fourth tool involves capital controls and financial channeling. Historically, governments have sometimes restricted the movement of capital across borders, limiting investors' ability to move savings into higher-yielding foreign assets. When savings remain trapped within the domestic financial system, governments can more easily finance large deficits without competing aggressively for capital. Financial repression is not new. In fact, it played a major role in the decades following the Second World War. many advanced economies emerged from the war with debt levels exceeding 100% of GDP. Instead of defaulting, governments relied on a combination of low interest rates, moderate inflation, and regulatory structures that directed savings into government bonds. Over time, the real value of wartime debt declined dramatically. The process unfolded quietly. Economic growth helped, but financial repression was a central component of the adjustment. What makes financial repression particularly effective is that it operates gradually. Unlike a sudden default, which sparks immediate panic, repression unfolds slowly. Savers notice that interest rates seem low, that housing prices are rising, that the cost of living is creeping upward. But the structural transfer of wealth remains largely invisible. Consider the effect on retirement savings. When pension funds invest heavily in government bonds yielding below inflation, the long-term purchasing power of those savings declines. Over decades, this difference compounds. The result is a subtle shift in wealth distribution. Borrowers benefit. Debtors see the real value of obligations decline. Governments finance deficits at manageable interest costs, but savers, particularly those relying on fixed income investments, bear the hidden cost. Another important dimension of financial repression is its relationship with asset prices. When interest rates remain artificially low, investors search for yield elsewhere. Capital flows into equities, real estate, private markets, and alternative assets. This process inflates asset prices. While this can create wealth for those who already own assets, it also widens inequality. Younger generations entering the housing market face rising property prices. First-time investors encounter elevated valuations across many asset classes. In this way, financial repression reshapes not only government balance sheets, but the broader economic landscape. Housing markets surge, stock valuations expand, debt becomes easier to service. But beneath the surface, the real value of cash savings slowly erodes. Critics argue that financial repression undermines market efficiency. When interest rates are suppressed and capital allocation is influenced by policy rather than market forces, investment decisions may become distorted. Resources may flow towards sectors favored by policy rather than those offering the highest productivity. Supporters counter that financial repression is often the least disruptive way to manage large debt burden. Compared to sudden austerity, which can trigger deep recessions, or outright default, which can destroy financial credibility, gradual debt erosion through inflation and controlled interest rates appears relatively manageable. In reality, most modern economies rely on a blend of these approaches. Debt grows, inflation fluctuates, interest rates shift. But underlying these dynamics is a persistent tension between fiscal sustainability and financial stability. The question facing many economies today is whether we are entering a new era of financial repression. Global debt levels have reached historic highs. Governments across advanced economies carry enormous obligations accumulated through decades of deficits, financial crises, and pandemic-era spending. Raising interest rates sharply risks destabilizing debt dynamics. Allowing inflation to run modestly above interest rates, however, gradually eases the burden. This environment resembles earlier periods in which financial repression became a central policy strategy. The process rarely appears dramatic in real time. It unfolds through subtle shifts in interest rate policy, regulatory frameworks, and inflation management. Year by year, the real value of debt declines. The purchasing power of savings erodes. And year by year, the balance between borrowers and savers quietly changes. Understanding financial repression allows individuals and investors to interpret these dynamics more clearly. It reveals why safe assets may deliver disappointing real returns. It reveals why governments prioritize stability in bond markets. It reveals why inflation targets sometimes tolerate temporary overshoots. Financial repression is not an accident. It is a policy environment designed to manage debt gradually. It is a silent wealth transfer operating through the mechanics of interest rates, inflation, and regulation. Most people never notice it happening. But over time, its impact reshapes economies, markets, and personal wealth. And in an era defined by unprecedented global debt, its role may become even more significant in the decades ahead. Welcome to Cash and Chronicles, where money, power, and history collide.